Economies across the world have been severely affected by coronavirus lockdowns to curb the spread of infection. Many countries are at different points in the coronavirus timeline, and so reopening their economies is complicated and will most likely require multiple phases, as experts warn that recurring waves and new infection clusters remain a constant threat. China has staged reopenings of many regions, commercial hubs and industries, while the EU, which the UN Tourism Agency says accounts for just under half of the world's tourism market, has announced detailed plans for many countries to reopen during their summer season. But some countries are feeling the pressure to reopen their economies more than others, even if experts advise against it. As of May 18, the US Department of Labor has recorded a staggering 36.5 million unemployment claims since nationwide lockdowns began on March 13, putting the total of Americans who filed for unemployment claims at over 43 million, with a real unemployment rate of 24.9%. which is just under the peak unemployment rate during the Great Depression. The US Bureau of Labor Statistics showed that the leisure and hospitality industry was the hardest hit, with a loss of almost 47% of total positions within the industry. Deutsche Bank recently updated their US GDP expectations, saying the US economy will shrink by almost 40% over the second quarter, and forecasted a net loss of 8% by the end of the year, the biggest annual drop since the Great Depression. Mixed messaging by the Trump administration and differing stances among state governors have contributed to a rise in the public sentiment towards returning to work, despite the fact that the US still records the highest number of new coronavirus cases every day than anywhere else in the world. The UK, which records the second highest number of deaths from the coronavirus after the US, has also seen significant contractions to their economy. In its monetary policy report for May 2020, the Bank of England states that the UK's GDP is expected to have fallen by around 3% in the first quarter and then to fall by a further 25% in the second quarter. And even though it forecasts a relatively speedy recovery, it could still take up to 3 years before the economy returns to the growth trend seen at the end of 2019. Prime Minister Boris Johnson announced an easing of restrictions starting May 13 that would allow unlimited outdoor exercise time and for people to meet from different households. And this is the first phase of a plan that could see schools and non-essential stores open in June and bars and restaurants potentially open by July. But reopening the UK economy is precarious, as coronavirus data shows that it's still enduring a significant wave of infections, more so than anywhere else in Europe. And the plans to ease restrictions have been met with backlash from health experts and politicians alike. Meanwhile, India looks to reopen its economy after more than 1.3 billion people were forced indoors for more than 7 weeks. Based on the number of coronavirus cases in each region, the government has split the nation into green, orange, and red zones to determine how restrictions will be eased in the coming weeks. Management consultancy firm McKinsey & Company reported that the nation's economy functioned at 49 to 57% of its full activity level during the lockdown, an opportunity cost they believe will not be sustainable in the long term. Their analysis points to India's reliance on internal supply chains, so that as the nation looks to open up in stages, economic activity allowed in one region could be constrained by the supply and demand bottlenecks in others. Deutsche Bank reported that India's top 10 COVID-19 affected states contribute to 66% of the nation's GDP, consigned mainly to red zones. As a result, surveys conducted by the Center for Monitoring Indian Economy showed that the country's unemployment rate surged to 27.1% in the week ending May 3. And McKinsey paints an even more dire picture, stating that India now has between 143 to 186 million inactive non-farm workers. To assist in restarting the economy, the government has proposed stimulus packages. Finance Minister Nirmala Sitharaman offered $62 billion in credit lines to small businesses and their supporting banks, along with a further $10 billion to electricity distributors. The proposals came as part of a wider mass financial rescue project pledged by Prime Minister Modi on May 12, with a budget of $265 billion, 10% of the nation's GDP. Overall, forecasters at Bloomberg Economics predict India's GDP will contract by 4.5% by the end of 2020, with Nomura Holdings Incorporated expecting a further decline of 5.2%. In South America, Brazil has emerged as the nation most affected by the pandemic, with cases skyrocketing through the second half of April and into May. As of May 19, the country, which has the largest economy in Latin America, has over 255,300 confirmed cases of COVID-19, with almost 17,000 deaths, the fourth worst-hit nation in the world. Despite the surge in numbers, President Jair Bolsonaro stands firmly against stay-at-home measures, At a news conference on May 7, the president, who previously likened the coronavirus to a little flu, seemed more focused on how it's affecting the economy.
There is a problem that's worrying us more and more, and that's the issue of jobs, of the stalled economy. Fighting the virus shouldn't do more damage than the virus itself.
His sentiments were echoed by Economy Minister Paolo Guedes.
Within about 30 days, there may start to be shortages on store shelves, and production may become disorganized, leading to a system of economic collapse, of social disorder. This is a serious alert.
On May 13, Brazil's economy ministry slashed GDP expectations for the year, admitting that the coronavirus will have significant impacts on the economy. They predicted a contraction of 4.7% by the end of 2020, the country's largest annual slide since 1900. The Brazilian real has also suffered, losing more than 30% of its value, the worst affected among major currencies this year. And the Bovespa index, which reflects the Brazilian stock market, slumped to an all-time low in March, dropping almost 47% from the start of the year. It's been hailed as possibly the world's worst-performing equity market this year. Consequently, President Bolsonaro has explicitly downplayed coronavirus concerns in an effort to rush plans to reopen the economy. On May 11, he declared gyms and hair salons as essential services to remain open during the coronavirus outbreak, alongside lotteries, churches, and industrial and civil production plants. All of this amid reports that hospitals are suffering severe shortages in beds in the hardest-hit regions, while people are resorting to refrigerator trucks, body storage, and even mass graves to cope with the number of dead. For some of the world's largest economies, a plethora of trade forecasts show that the coronavirus could spell economic recessions greater than those seen during the global financial crisis of 2008. Many may be forced to reopen their economies in an effort to stay afloat, but without proper coordination, countries run the risk of recurring waves of infection, which, in turn, could spell even worse economic downturns. So, can the world's top economies find a way to return to pre-coronavirus trends?